Well, we are in continuing coverage right now after Donald Trump delivered on his threat to hit Canada and Mexico with 25% tariffs. We're watching the currency market closely as well today. As you know, the loonie has lost a lot of momentum against the greenback in recent months, in part because of this tariff threat. Let's bring in Mark McCormick, who's Managing Director and Global Head of FX and EM Strategy at TD Securities, to talk a little bit more. Mark, maybe I'll get a little specific on the morning itself, because it looked like initially there was, interestingly, some buying in the loonie against the greenback. Maybe because all of a sudden people were worried about the U.S. economy and the possibility of big Fed rate cuts starting to get priced into the market. Since that initial movement, it looks like the loonie has kind of been shifting between weakness and strength against the greenback. What are you seeing?
I think what you're doing is you're balancing two opposing forces. One is that the market's gotten very complacent on trade uncertainty, and you can see that, I think, expressed through global macro volatility. In the FX world, this kind of plays out as a shift towards risk on, or EM carry is a strategy that outperforms, or again, it just dovetails entirely with the market having bought the dollar for a long period of time and then reversing positioning. All those things are kind of working right now. This is the other side of this is that I think the kind of America First agenda and the recent developments we've seen has kind of forced the world to choose to engage in its own supportive growth policies. So I think what you're starting to see is, this is very clear what we're seeing in Europe is there's going to be more spending. There's going to be more defense spending. That puts a bottom in the growth story. That raises the market's potential expectations of where things are going. And this is coming at exactly the same time the U.S. data is starting to underperform. I think the tricky balancing act here is, one, is there some seasonality or distortion in the data that comes through the port strikes, the hurricanes, the weather, the LA fires. There's a lot of things that have happened that are temporary that could definitely distort the data, or whether or not there's a trend general slowdown. We are not seeing the trend general slowdown in the data that we track, and a lot of the models that we run still tell us to be long the dollar. But I think the market's trying to figure out which direction those countervailing forces are taking us.
All right. If we go back to the fall, our loonie was actually above 74 cents. Here we are below 70 right now. I'm sure you get asked every day, what's your outlook for the loonie? What is your outlook for the loonie, Mark?
Yeah, I think we're going to see kind of the max pain here in this quarter, where we are looking for a forecast below 70, somewhere around, I'd say 70 to 67 is kind of the range. Primarily, again, as a function is the way we're kind of describing is that there's dislocations in the market. And those dislocations are, again, there's too much macro, we call it geo-macro, which is geopolitics and economic, too much macro uncertainty, not enough volatility. There's too much inflation, and there's too much of a pursuit of central bank easing. And then again, at the final, there's too much outperformance in European assets, or a reduction in the risk premium relative to US assets, which still offer better growth and still relative opportunities. So the things that we're seeing is that dislocation, if it results in a stronger dollar as we're expecting, that would push the loonie lower. Largely, again, because I think one of the things you'd like to correlate really well as an investor to think about what drives CAD is to look at volatility. It is a high beta currency. It tends to underperform when there's stress in the markets. And the two kind of viable currencies you have that are proper safe havens right now is the US dollar and the yen. Swiss can also play that role, but I'd say, the big concern here is if this is a tariff shock, this is a growth shock, this is essentially negative or this is negative for the carry trade, or this is bad for volatility, this is going to have an impact on like the currencies like the Canadian dollar that will suffer either through higher volatility, weaker growth expectations, or further divergence in central bank pricing.
And look, I know you focus on FX strategy, but I think one of the big questions for our Bank of Canada, they're growing expectations in the market today that at their next meeting they could cut rates again. Without this tariff story, look, we deal with what we deal with, but without it, we actually saw some reasonable performance for the Canadian economy at the end of last year. But I guess one of the considerations for them, if you're navigating a growth shock with the inflationary threat from tariffs, and then in addition, arguably a little bit of imported inflation through a weak loonie, how do you think the Bank of Canada is going to be thinking about the currency's level in the next few weeks?
That's an interesting point, because I think this is really an interesting story that ties different pieces of the FX story together. Like, one, I think in the U.S. you should not be worried about the growth shock. I know we talked about the Atlanta Fed Now tracker, but essentially there's a lot of distortions. And again, if there's something that's happening, at least in the U.S. side, there's front loading of tariffs, which does distort the data. I think so. If you're looking at the U.S. market, you should be worried a little bit more about where inflation's at, given the strength of the economy that we've seen over the last 6 months, the last 12 months. With the Canadian economy, I would argue you should be more worried about growth and less worried about inflation. And again, the volatility in the currency tends to have the first impact, or tends to, this is a first shock absorber. The one thing I wouldn't be too worried about for the Bank of Canada is dollar CAD itself, because the trade-weighted CAD hasn't moved to levels that I think would be concerning for them, that they if they cut rates too much to focus on growth, that there'd be a currency problem, that you start to import too much inflation. So in my perspective, I think, again, this is why we're also bullish the dollar, is for the US, you should be more worried about the strength in the inflation data, and then be worried about the growth shock that could be coming in the second half as a second order effect. In Canada, you should be worried about the first order effect of the growth shock, which again kind of sees you could see more divergence, or at least more volatility around the pricing of divergence over the next month. So I'd say here we are in what we feel is the peak for the strong dollar's coming. We think it'll be in Q2. And then we think after that, we're going to see a very big, significant fall in the dollar as a lot of these factors unravel, and some of these second order effects take effect. And this would be beneficial for the Canadian dollar, because it would basically strengthen with all the other currencies, as a falling dollar would be a tide that lifts all boats.
Okay, we're almost out of time, but I just, for those who don't follow the currency market as closely as you do, you're saying that if the loonie starts to benefit from people moving out of the U.S. dollar, it's not because we should expect a whole flood of rate cuts by the Fed this year, which some people were starting to wonder about if that would happen this year. It would just be sort of a changing in the tone. But you're still in the camp that would see more likelihood of rate cuts in Canada versus the U.S. in the short term. Is that fair?
Absolutely. I'd say in the short term, talking the next 3 months, longer term, next 6 to 12. So using that framework, the next, 3 months, you should be more worried about Fed, more cuts coming out of Canada, less from the Fed. And I think over the next 6 to 12 months, you should think the opposite, that the second order effect of trade uncertainty and the policies that we're having could have a negative implication for the US. But what you're starting to see is the rest of the world is starting to build guardrails around their slowing economies, and we're starting to see increased fiscal stimulus, increased defense spending. Those are things that can help weaken the dollar, particularly as people are looking for value in other markets. It's just that is not the trade now. That is not the trade for the next 3 months. Yeah. But that's how we are forecasting the evolution of the FX market in the next 6 to 12.
Okay, Mark, really appreciate it. Thanks very much. Mark McCormick joining us from TD Securities.